This Saturday, we have 3 interesting webinars for you. Morning 10 a.m., we have Mid and Small Cap Mutual Funds Navigating Underperformance and Value Traps by Akash. At 10 a.m., we also have another webinar, Precious Metals Time to Shine or Lacking Lustre by Samyuktha. At 11 a.m., we have Insurance Impact of GST in Health and Term Insurance, Right Time to Take Insurance by Abiraami. What are you waiting for? Register now.
How has the market's reaction to the changes in the GST regime been? Before the announcement, people were expecting that stocks in sectors that would benefit would go up sharply. In fact, on the day of the announcement, that was the thinking. The next morning, we did see some sectors see a sharp bump in prices. But that rally in stock price got sold into very quickly. One good example was insurance. The story was that earlier, companies used to get certain expenses done as payments towards getting business and get credit on that GST. Now they would lose that credit. So it was seen negatively. But I think all these are just narratives that are being spun by people. When you reduce GST from 18% to 0, how much of credit would a company have got? What would be the magnitude of that? All this seems to be exaggerated to me. On the other side, stocks of some industries did see a sharp bump up, like two-wheelers, cars. All these manufacturers have seen a sharp spike in prices. The consumption basket has not been as enthusiastic as the auto basket, but it's still seen some positivity in pockets. But one thing is certain, we continue to see very strong selling by the foreign institutional investors in India. We are a very liquid market for them amongst the emerging markets, and so this selling is probably bound to continue. Another aspect which is largely overlooked by the market is that the multinational companies are seeing the Indian market as a source of liquidity in their stocks. Promoters of MNCs are more than happy to sell in India and take money to their parent balance sheet, which looks distinctly weak. This could be an event that will recur in multiple companies. So we saw some selling in ITC. We have seen some selling in some random companies like ZF and Timken and all these companies. But we are going to see this spread. You will see it happen in more companies where the MNC comes and sells in India. So this will keep the pressure on stock prices of consumer-facing companies. I think the need for promoters to sell their equity is going to take away the possible gains that we will see due to the change in GST rates. So I think largely this move will be stock valuation or price neutral. Just that we are seeing this initial froth in stock prices, but I am of the view that like the nature of froth, stock prices will settle. So it's not such a big event despite being a very big economic event. From a market perspective, this event shall pass. That's all. It's not a big event. So investors can take a longer view of things, think what will happen in the longer term, decide what is their valuation comfort at the company level, and stick to their investment discipline and valuation limits. So wait it out. See if you're getting what you want to buy at the price you like to buy, and buy when you think the price is right. So you don't have to be driven by whatever sentiment this GST change is creating, because in my assessment, this sentiment is not going to sustain or improve. I think the bump up in sentiment will slowly readjust itself back to where we were before these announcements were made. The reason is very simple. Before the announcements were actually made, sentiment had already factored in all these changes. So it was more or less expected So there's nothing that is not in line with the expectations, but all these changes are long-term shareholder value accretive. They will create better shareholder value going forward. Businesses will do better with all these changes. I believe that growth will also improve with a slight lag. So things will get better at the company level in terms of growth in sales, profits, and return metrics. You will have better ROI in most companies because of this. But still, the extent of operating leverage which you need to justify even the existing valuations of several consumer-facing businesses is very high, and it is going to take time before you see that level of operating leverage at the company level. But as a consumer, it's a good time, it's a great time to go out and buy whatever you want. You're going to get everything cheaper than what you would have paid prior to the change. Also, you are staring at the prospect of lower interest rates going forward, which would make a lot of consumption driven by loans like two-wheeler, four-wheeler far more attractive. So it's good time to be a consumer, good time to buy, good time to spend, but it may still be some time before you think it's a great time to invest. So it's good to buy the company's products. It's also good to buy their shares only at the right valuation. That's the sum and substance of what we are seeing now, and that's what you need to keep in mind. Happy investing.